appreciate the opportunity here. Interesting times that we are in. October, volatility, seasonal sell-offs, and we've got some new changes to our outlook and you know, trading suggestions and ideas for people. So gonna look a little bit at said, you know, long-term forecast, the 38,820 briefly. I think that sort of set things up for the longer term. Drill down into the current pre-election year patterns and how that's playing out and how we've been working with that this year, and then into the best 6 months and some of the sector seasonal setups and what we'll be looking for in some stocks. But just a word from the lawyers before we before we get rolling. This is for informational purposes only. Not an offer to buy or sell anything. Past performance not a guarantee of future results. Do your own due diligence. Consult with your own advisors, etc., and so forth. And with that, I'll just give you the basis for you know, what we do and how we look at the markets and you know, the old Santayana quote everyone knows: "Those who fail to remember the past are condemned to repeat it." One of my new favorites since I'm reading a book on John Adams is Patrick Henry's "I know of no way of seeing into the future but by looking at the past." So we like to think that those who study market history are bound to profit from it, and that's our sort of guiding light in our philosophy. Some of the books that you know, were mentioned in the intro are there. The 2016 Stockholders Almanac should be hitting the warehouse this week, next week, should be available soon. Unfortunately, I know I saw a friend on the line there. We have we're not able to get the Commodity Traders Almanac out for 2016. We just got the rights back from Wiley a little too late to make it all happen, but we're working on doing it for the following year, which hopefully will be out around this time next year. And you know, a little bit of history about the Almanac. I don't know if some of you know the you know, where it all started. My father, who will be 92 later this month, started the Stock Traders Almanac in 1966, incorporated the Hirsch organization the year that I was born, so I'm 49, same age as the Almanac, kind of grew up with it. He had been working for a place called Indicator Digest back in the early 60s, which was started by a relative of ours, Sam Coslow, and they took all the indicators. You know, he was in the Hollywood and songwriting business, but he had gotten burned in the market when he sold his little publishing company to RCA for stock, got hit in the crash, and then became a student in the market and had this service, Indicator Digest, which ended up, it was out of Palisades Park, New Jersey, ended up being quite a breeding ground, a proving ground for newsletter writers and market analysts. A lot of people came through there over the years after my father left. So a few years later, he decided to take all these indicators and organize them in a calendar format so he could track the market's schedule along with the calendar in his. And the Stock Traders Almanac was born. The first edition came out in 60. It came out in 67. It was the 1968 edition, and it's been you know, a nice ride ever since. And people have been appreciating it. We've been trying to improve it, and hopefully we continue to do so. So the process is kind of simple. You know, a little old school. First, we start, you know, from our vantage point of cycles, seasonality, recurring patterns, and then we we'll look at current trends in the economy, you know, especially now with the talk every day of the Fed and central banking and what's going to happen with, you know, global growth and that sort of thing, and the phantom, or not the phantom, but the sort of dubious employment rate out there. And then we'll look at, you know, monetary and government policy. We think that there's quite a bit of headwind there with politics, as it has been for the past several years. And then we start to drill down into market internals and sentiment, advanced decline lines and new highs and new lows, and put call ratios and you know, just internal market performance, as well as fundamental and regular technical analysis. And I find it interesting hearing a lot of this being bandied around and talked about on the financial news shows a lot lately, with people talking about wedges. And, you know, I mentioned MACD, and people's eyes light up now, and it didn't used to be a you know, even respected so much in that circle. And I think a lot of it is due to the MTA and the efforts that Ralph Acampura and that whole group have put out there for years to bring the discipline of technical analysis to the forefront and even to academia. So let's just look at the long history. I think this is the chart that Josh Brown calls his favorite chart on earth. I took what Yale did back in '76 when he made it his famous, or at least incredibly accurate, forecast for a 500% move plus, at least from the Dow from the 74 low, which was right around here, of about 570 intraday. He based it on the historical moves following the secular bear markets over here at the left of World War I, with the inflation rising about 100%, and the Dow rallying 500% after that, and then the same thing after during the Depression of World War II, where you had this flat sideways secular bear market and this inflation increase of 74%. Dow rallies over 500% here, and then of course Vietnam and the rampant stagflation of the 70s and the information revolution, and you get this well over 500% move. So this was the basis for our forecast for Dow 38,820, which we put out originally in May of 2010. Just a few points about this chart. There's a lot of notes we put on. A lot of people try to pigeonhole cycles into defined periods. We tend to use events and dates. You'll see, the beginnings and ends of the wars here with the assassination in 1914. Remember, the market was closed for several months from the end of July through mid-December, and then Gulf of Tonkin being the arguable beginning of Vietnam, the fall of Saigon. We've got here for World War II, the invasion of Poland and the Japanese surrender. We had the war on terror, sort of marking the beginning of, the current and what I believe is still the secular bear market. I think we'll have another, cyclical bear over the next couple of years that will be the final end, sort of like the 1982 moment, this section back here. So this is what had us thinking that after the low in 2009, that we were beginning to trace out the end of the secular bear, and that's a whole other debatable issue for some people, us being a little bit higher than that, than the 2007 high, but that's not necessarily indicating that we're here at a new secular bull market yet. Yes, we've seen the bottom of it, so we're looking forward to probably a couple of tough years. And when I put out that book, which came out in 2011, Wiley asked me to put together a projection of what we saw the outlook of the forecast would be, and using all of the secular patterns and the cyclical patterns within the secular patterns, the seasonal patterns, the 4-year cycle patterns. Admittedly, I had Ned Davis's Markets in Motion book, the big flip up one that has all the histories there, and I sort of traced out what was this blue line here initially, simple Dow closes, for the month, where I thought the market could trace out, and the black line here being the actual performance of the Dow since. I've left it sort of for posterity to see, how my thinking was back then, and some of the changes we made. So you see, in the beginning, before the QE party really kicked in, we were sort of tracking the cycles and the seasonal patterns quite closely, and our projection. And remember, this is a projection, not necessarily, a prediction. And then we made an adjustment after the market sort of got kind of high on the Fed Kool-Aid, and in January 2014, I drew the red line, sort of raising the floor. Again, an update. We started doing it, kind of twice a year. Update in July of 2014 with the green line, and then recently in the spring of this year, traced out the purple line here, which is even higher. I don't think we're going to get, much lower than the old highs of 2007 perhaps, but this is still, your average 20-30% bear. So kind of back on track, tracing that here. Didn't quite get as high as we had forecasted, potentially as high as 19,000. We got kind of close, month there, and a little bit further downside here, but thankfully this was in the worst months of the year, so we were prepared for that. And let's sort of zoom in a little bit and look towards what's going on here at the end of pre-election year 2015. Coming in, we were hearing a lot of talk of the pattern that we've been promoting for many years, that the third year of the presidential election cycle is the best year. We call it the pre-election year. And looking a little bit further into it, we found some potential problems with this year particularly. But just one of the quotes that we have in the Almanac that underscores the existence of seasonality and the four-year cycle from Nixon. Dr. Burns, who was his political economic advisor at the time, and ended up having a rough stint as Fed chair before Volcker came in the 70s. Early in 1960, Burns calls on Nixon, and his conclusion was that unless some decisive action was taken soon, we were headed for another economic dip, which would hit its low point in October, just before the election. So there you have, a president and his economist talking about seasonal economic and market behavior and the election cycle. So just to highlight the four-year cycle here, since the last loss in the third year in 1939 when Germany invaded Poland, and you can see that the third year has improved quite a bit. It's up 16%. We have often gotten these sort of bottoms in midterm years. This time we got it in the post-election year of 29. Prior to that, with the sort of roaring markets that were going on, we did not get our usual midterm bottom in 1986 or 06, but there were other I guess 2010 there was a decent little low point there, but we've seen weaker election years, and I think that doesn't bode very well for next year, especially with the contentious activity we have already going on with the candidates, either intra-party or across party lines, with Mrs. Clinton and the majority leader of the House. Some shots fired across the aisle, kind of interesting, but that causes uncertainty and makes Wall Street a little bit iffy. You can see the impact of the financial crisis here, with the 2008 drag on the election year, and also remember we had an undecided election in 2000, but 2012 was pretty much back on track. So it's something to be looking out for going forward here. Something that we call this, whoops, did I pause that? No, I'm just trying to move this box out of the way here. So the sweet spot of the four-year cycle was not so sweet this year. What we've highlighted here, and one of the reasons we've been quite cautious so far, throughout at least the middle part of the year. You see the 3 quarters from the Q4 of the midterm year to Q2 of the pre-election year being very strong, averaging 21+%, 22 on the S&P, 34 on NASDAQ, and then the middle quarters, the weaker quarters, Q2 and Q3, being pretty lousy basically in the midterm year for S&P, Dow, and NASDAQ here. And then we just looking back at it, the history from 2010 over here on the left side was pretty spot on. Decent performance there in 2010, 2011, but this time around we had pretty solid activity thanks to the Fed pretty much. And some decent economic activity last year. And then we've seen much weaker performance in the sweet spot this time, which I think is instead of 20-some-odd%, you've got 3 and 4 for Dow and the S&P. Instead of 34, you've got 11 for that 3-quarter period there. So another negative indication for this year earlier on. So looking at another pattern that we follow for the four-year cycle is the midterm, the gain about 50% from the midterm low to the pre-election year high. I'll tell you right now, it doesn't look like we're going to get anywhere near that. I don't think we're going to get much above the new highs. I mean, the previous highs by the end of the year, if ever. This cycle at some point eventually, yes, but that may be all all we'll get for this bull market. It may drag out for a little while. We could poke a little bit higher, but the interesting thing here, is the midterm lows. Most of them, or the majority of the clusters, is in January, highlighted in blue. A big chunk in October. We know there's several other lows in October. October's been that turning point. Great buying month. It's got its history. Almost a January low here in 2014. So far, the high is in May, about 19%. But the good omen, or the positive outlook for the rest of this year, is that December has been the area where we've seen the most pre-election year highs, and 9 of those in December, and 6 of those on the last trading day of the year. So one of the reasons it gives support to the year-end rally this time around, especially here with the pre-election year and looking like we're about to break out, or waiting for some confirmation of that. But here's the rub. This is not Obama's first time around. He's a second-term president. Granted, there's not a whole history, a whole large sampling for the history of the S&P of 2-term presidents, about 6 prior. And here we've traced out all pre-election years in the blue line. This nice, double-digit return, and then just the 7th years, which is not like 7th year like 2007, but the 7th year of the term, the second pre-election year. You can see the effect of 87 over here in October, and you can see it's a much more muted gain, some year-end rally. And then throughout the year, we've been tracking where 2015, fits in this picture, and you can see that it's tracking very close to the 7th year pattern of lower returns. We're not getting that big pre-election year push. You basically have a president that's, spent a lot of the political capital, and people are disenchanted with them, and they've disappointed, and the policy misses, and that sort of thing. And so they don't have the ability to prime the pump that they did in their first term. So this is eerily similar to the 7th year pattern, and I think we'll probably get another, 5-6% towards year end, maybe get up to the old highs, but I wouldn't expect much more than that, if that at all. So look at the 4-year cycle and how it impacts this year. And now looking forward, the best 6-month switching strategy. This is what's going on live right now. Everyone knows the phrase "sell in May and go away." I've got the picture here of the horses, which is from the St. Leger's Stakes in England, which the old British saying is "sell in May and go away and come on back on St. Leger's Day," which is the final leg of the British Triple Crown, the thoroughbred race, which happens, I think it was September 12th this year. It's usually mid-September. And I don't know if anyone has seen the Downton Abbey series, but you get an idea of the pattern, the cultural behavior that very similar to our Memorial Day to Labor Day period, where in May everyone leaves the city, or used to, and kind of still does, and goes up to the country. And then when after this horse race, they come back in and start doing business again, kind of like the Wall Street exodus to Hamptons, and all of the lower volume that you see during the summer. And that's just the history of where that saying comes from and why it exists. But looking at our actual system, which Yale created in 1986, came out in the 87 Almanac. And back in 2006, I think it was 06, we picked the book Evidence-Based Technical Analysis, if memory serves. His name is written by David Aronson. He's, I guess, a member of the MTA, or involved with them, the Market Technicians Association, and works out of Baruch College in the city, which is one of the places that's been promoting technical analysis for many years. And he and his professor colleague, Tim Masters, I believe, put 6,000 different black box systems through the scientific method of disproving the null hypothesis, that basically taking whatever system and results that they were looking at and saying that it was false and just the result of chance and had no predictive power. And he found none of them to pass to disprove the null hypothesis, to have predictive power, and not be the result of chance, except we asked them to do it with the best 6-month switching strategy. Just a simple, end of October to the end of April, and the end of April to the end of October, and he found that unlike the other 6,000, it was not the result of chance and did have predictive power. So what we do is, we don't sell in May and go away. We do sell some things in May. We will, go short stocks in the worst 6 months and long in the best 6 months. We use different ETFs and other indices, and we improve the results, which I'll show you on some charts in a moment, using MACD and other technical tools. I'll explain MACD a little bit. I'm assuming many of you do know what it is. And it's really just sort of a change of mindset from being more aggressive to more defensive. And of course, you can use options and leverage. And we will look at some other indicators like the advanced decline line. One of the examples of that is a trade I like to point out that my friend John Person puts on when he can. He did it a couple years ago by using the TZA, the leveraged inverse small caps. It's like the short Russell ETF, and he was looking at the Russell 2000 going up. I think it was 2012, if memory serves, and the advanced decline line going down as the index going up. Definitely a divergence that you could trade, and to make that trade, he put on a simple vertical bull call spread on the TZA. I think it was about April, so he used just a month out expiration in May, and sold, bought a 16, sold an 18 when the TZA was about 14 or something like that, and over 3 weeks, logged like a 80-some-odd% gain on a small trade, a speculation, but one of the ways that you could, as an active trader, you can utilize some of the trading ideas and investment ideas that we put out there, not just the straight index that we might talk about or a straight stock. There's a lot of things you can do depending upon your style and what you find effective. So the chart from the back of the Almanac, still pretty much the same thing, highlights the moment of truth, the aha moment that Yale had back in the 80s, which looking here, you can see the weak months from May through October. We're seeing a little more strength in July and October over recent years. Best month to buy being October over here, but you see September and August, the worst 2 months of the year, and you have the best 3 months, November, December, January, March, and April, the best Dow month. You got the best 6 months right there from November through April, the worst 6 from May through October. For NASDAQ and the Russell, these May and June are a lot better. It's a best 8 months, worst 4 months, and you'll see some of the recent signals we've had there and the success we have with that. But one of the, I guess, more current ways that we like to look at this is these 1-year seasonal pattern charts, something that we produce on our internal software. I'm sure lots of other software does it, but you get a lot of over the years, you get a lot of people trying to debunk and refute seasonal patterns and seasonality and its efficacy, and they'll go back to 1896 because that's when the Dow data starts and say, oh, well, sell in May didn't work. Well, of course it didn't. It was a different world back then. It was a agrarian society, the first half of the last century, which is when we have the most solid data. Most of the country was into farming, and you can see the cash flows that drove the economy, that drove things come into the market. It was almost buy in May back then. And this is the light blue line here is 1901 through 1949. You can see it flip from 1950 to, through last year, 2014, the black line here. And then even since 87 crash, just to try to compare, more current activity to longer activity to make sure the pattern still exists. You see this flat period, it's not sell in May and go away. It's from May through September, October. The market does a lot less. You see a lot more down moves and corrections, and it's a period of less probability of market advances. So this is sort of a nice way to highlight the pattern. Looking at some actual numbers here, the compounded performance, the annualized performance since 1950 for the best 6 months is 14.6%. The worst 6 months, or the sell in May strategy, is minus 0.1%. And taking a $10,000 investment, just as an initial one-time investment in 1950, in the best 6 months gives you a gain of $838,000 versus a loss of $221. But you know, we like to use technicals on top of these things in conjunction to sort of, you know, get better entries and exits. And you can see the difference here when you use the simple MACD timing, and we use two different MACDs. The buy side MACD is 817.9. The sell side is 1226.9. You'll see it on the chart in a second. But that performance, you know, the annual performance increases to 17.4 in the worst in the best 6 months, and gets worse in the worst 6 months to minus 3.4%. And the $10,000 almost triples the results of just, you know, doing it at the end of the month, increases it to over $2 million, and the loss expands. And it's a little bit more now. It's about $6,500 loss, but that's increased because we were down about 6% on the Dow in the past, the most recent worst 6 months. And you know, sometimes it doesn't work. Nothing is 100% all the time. And one of the things that, you know, got us really cautious in the market in 08 was the fact that the best 6 months were bad and they weren't up, and that's an indicator. There's another quote I like to you know, pull out from a gentleman named Edson Gould, who left us in the 80s. He had a service called Findings and Forecasts, and to the effect of, you know, if the market doesn't rally during the favorable seasonal period, there are other forces at play. When that favorable seasonal period's over, watch out. And that's what happened in 08, 09 also. We had a pretty negative best 6 months, and then the market rallied in the worst 6 months of 09. So I wanted to take a look at the recent performance, seeing if this seasonality still exists and the pattern was still viable, and it is. Here we're still looking at 10, 11% here in the best 6 months. Now that we've had a loss this year, we're down to a negative number again for the Dow here, just a sort of flat number on average for the last several years for the worst 6 months for the S&P. And here's a look at the recent signals and the crossovers that we look at. For those that don't know, MACD or MACD stands for Moving Average Convergence Divergence. It was created by Jerry Appel many years ago from out there in Long Island, Signals and Forecasts. And what it is a series of exponential moving averages, and exponential moving average being a moving average that is more heavily weighted towards the current period. And for the buy side, he found that using a shorter or a faster MACD was more effective in confirming a buy idea, whether it be a fundamental stock pick or a seasonal index trade or whatever it might be. And using a slower MACD, a longer moving averages time frames, because tops tend to be more of a process, as you can see right here over the better part of this year. This is several months. Bottom, this one took a little bit longer than the V bottom we had last year, but it's more of an event, and we're looking for a faster confirmation here. So you take for the buy, you take an 8-day moving average and a 17-day moving average. You take the difference of those two, and then the pink line is a 9-day moving average of that distance. And when you get this crossover here of the MACD line, the difference going through the moving average of the difference, that's a buy signal. On the flip side, this is a clear one here. You get it coming through above the zero line as a sell signal. It's more convincing when you are below the zero line for the buy signal here. We recently just issued this, so we're getting into all the sectors and putting together some basket of stocks like we do every year later in this week. And we have confirmation on all of the 3 major indices. We issued our signal just Monday. And You can see that crossover right over here. Just to give you an idea, Dow was up, S&P was up 7.4 during the best 6 months. Recently down about 4.5%. We had a drop of 12% all during the worst 6 months. So looking at it on the NASDAQ side, and this one of the subscribers had called up, and it's just I picked up the phone to find out, just do a little recon, a little QA, and asked him. I was calling up to Renew and asked him, what he thought. He said, "This is great." He ended up sending me a testimonial. Basically, when he got the buy signal in October, back here, he took $1.5 million out of his IRA and put it into the QQQ. Then when he got our sell signal here in June, he sold it, and I think he made about 11 or so percent. Took about $170,000 or something like that. More into his IRA. So here we see, the crossovers here for the NASDAQ, the buy signal here, the sell signal back here in June. You see the 14.5% gain, close to close. Not really picking bottoms or tops, sort of getting out, and in to, capture the bulk of the move. Down about 6% here, from the high to the low, almost 18% for the NASDAQ. So the point here being to avoid, the seasonal volatility, either by tightening up stops or taking some short positions, or just being a little bit less aggressive getting into the market. So let's look at some of our seasonal sector trade setups. Recently, we've put out a basket of sectors that we like to get into around this time of year. Been a little whipsaw with the biotech, but that does happen from time to time. That's why we have stops. One of the things that we came to light earlier in March, when we had closed out our biotech position, that's when that sector seasonality tends to end, and it kept going up a little bit. So I was brought to my attention by my colleague Joe Childrey over Probabilities Fund. This guy at Guggenheim, Scott Minard, had been quoted in Barron's as referencing Baron Rothschild's success formula. I never buy at the bottom and I always sell too soon. So we're pretty sure he's got an almanac on his desk, and this is the one that's right out of the almanac. So picking bottoms and tops are not something that necessarily happens, but getting close and near where the inflection point is, using our technical indicators, is something we do try to do, and do get done pretty effectively much of the time. So our sector rotation strategy, a lot of stock sectors mixed in with some commodities, or some overlap with things like oil and gold and that sort of thing. We go long and short at different times of the year. And we try to find highly correlated stocks and ETFs. It's a lot easier these days with ETFs, trading, getting short or inverse any particular index you don't like, or that's in a seasonal bearish period. And also there's a lot of stocks that we will, find off the radar that we'll get into either on the short side during the weak months, April, May, June, or the long side coming up pretty shortly. So our stock sector seasonality table, it's right out of the Stock Traders Almanac. This is like page 92 or something, for anyone who has one or wants to get one. And you can see the cluster here of all the sectors getting bullish in the October period of time. We like to write about these and get people thinking about them and looking for buy limits, near support ahead of October. Couple start to come into play in the summer with gold and biotech and high tech. You see some of the short trades in materials and natural gas and banking and other sectors here. Oil short. This is sort of the going to the end of the year. That's sort of post, what used to be the post-hurricane trade after, we had all the trouble in August, September. Market would sell off, and you get kind of an oil bottom generally in December. And what we like to look at here, we put beginning, the B and the E and the M is beginning and in middle of the month. So we look for the season to start at the beginning third or the middle third or the end third. And we're looking at, several different time periods here, 15-year, 10-year, and 5-year. We want to see what this seasonal pattern's done, in the real short term, what it's done over the decade or so, what it's done a little bit longer than that, just to sort of cross-reference the different time frames to make sure that the pattern is still worthy of attention. So right now, this is yesterday's update to our portfolio, so you're getting a nice little look-see into what we've been doing recently. Here's our, whole Almanac Investor Newsletter ETF portfolio. We just closed out the Ranger Equity Bear, which is an ETF that short stocks. We had a little bond position in the AGG and the TLT. That was sold out when we got our signal from Monday. The transport short we covered. We got stopped out of a couple. Here's one that's, we're getting back into the biotech. We like this iShares IBB. We actually own some ourselves right now in our client accounts. But we got 10% stop loss. You got to leave a little room for some volatility in biotech, but we don't want to give too much away. So stopped at about 315. It's gone even lower. You can see that at the bottom. We're getting back into it right around these current prices. I think that's not only a great short-term trade, but it's also one of our favorite sectors for the long term. And you can see we're getting into, I think we also picked up the XLV in our portfolio. We've got some IWM and some QQQ. This is in the the actual trading account we have. But you can see a nice pickup, and we had these buy limits in there below the market. Some of them we haven't hit yet. We're going to leave those there. Probably some more volatility here in October, but if not, we'll either, if it runs away, we'll pass on it. If it's still looking good, but a little bit higher, we'll up our buy limit and get into these here. So this is all available, at stocktradersalmanac.com if you want to look at it a little bit further. So the next thing that we do for the October buy is we put out a stock basket. Sometimes we'll do it a little bit earlier depending on what the market does, but what we do is we run some fundamental screens through Zacks. We look at MarketSmiths also. Nothing, we're not reinventing the wheel here. We're looking for revenue growth and acceleration, earnings growth and acceleration. We're looking for good valuations, price to sales, and PEs, decent ratings. And we sort of break it out into 3 different market caps, and we make sure there's some insider holdings and some liquidity, that there's some decent average daily trading volume that's tradable. I'm not going to be looking at micro cap stocks and penny stocks. That's a different ball game, and I don't play that anymore. I played that game a little bit, and it can be good, but you got to be on it all the time. And then we'll look at some technical stuff, relative strength, some chart patterns, look for support and resistance, and look at moving averages and pick some buy points on there. And we'll rely not necessarily, top down, looking at sector seasonality strength, but once we see what comes through the screens, we'll see if there's any other themes, either a sector that's showing up a lot, or a group of stocks that are in a sector that are in a real bullish season. So, as I said in October, we're getting into longs. I can tell you that we'll be putting out this basket tomorrow to subscribers. I'll show you some of the shorts that we looked at over the summer. And for picking those shorts, you basically invert the screening criteria, where instead of looking for growth and acceleration, we're looking for losses or deceleration or revenue going down and overvaluations. So kind of old school fundamental analysis and technicals. And if you do the homework and you put the market through its paces, you come up with some good ideas and some profits. And of course, a lot of these are optionable, and there's a lot of more sophisticated trades for those of you that do that kind of thing out there available. So this was the basket of less desirable stocks we picked up back in July. One of the ones that did quite well for us was Bluebird. It was a really price to sales ratio here of 228. That's just a red flag for us. So some interesting trades here. McDonald's, I thought that was kind of interesting. That was about when they were coming out with their artisanal sandwiches, which I thought was kind of amusing coming from McDonald's. So this is the kind of stock basket we're putting on the long side. This is the shorts. And just to give you, a little look at how we look at these things, this chart from Trade Navigator back here in July, we were looking at a breakdown through, the sort of pivot point support level here. Kind of dipped below that. It was either that or fail at resistance, and this is one that didn't work out very well. So we stopped out on this when it went above our resistance level, about 25 or so. So that's one that, all these shorts don't work. But Praxair short worked pretty well. Broke down here through support back in July. This was closed or covered yesterday, probably around this 100 level or so. I'll show you that in the table in a second. So this is one of the more effective short trades. And one of the things that we look at is, I don't know if you use MarketSmith, but if you're looking at individual stocks, whether you're trading them technically, options or otherwise, a lot of great information here coming from Bill O'Neill's paid site. And you can kind of compare your picks or your selections over here on the side with, either Bill's checklist, or there's a bunch of other names in there that you can pull out, and you've got all the ratings here from earnings and distribution, earnings, forecasts and estimates, and just a lot of different information here that you can just quickly glean to see if the stock fits your criteria, either being a good long trade or something that you might want to short or put together a downside strategy on. So we sort of check ourselves against somebody else. Current portfolio for the small caps, nice and thin, with a whole bunch of sort of hypothetical cash on the sidelines to put into here. And you can see that we've covered this Blue Knight energy here for about a 13% gain on the short side. We've got a couple of our longer term hold on holds. This global brass and coppers was a seasonal copper trade. A couple years back, we picked up Southern Copper, and so this past December, we put out this smaller cap copper trade or copper concern, and that's doing pretty well here. A couple other ones are okay. We stopped out here for a decent game, when the biotech swoon there. Unfortunately, we got pulled out of these, but we logged some gains on that, and we've got some little longer term hold on this new tech business services. And the mid caps, one of my favorite airlines, JetBlue, stays in there. Be flying them next week to go out to Vegas for the Traders Expo. Usually end up on flight 711, which I find is kind of interesting, going to Vegas on flight 711. So couple covered here. Not a massive gain here, but a couple of short opportunities that we capitalized on, holding some of the longer term. We just had a double. One of the strategies that we use for stocks is selling half on a double, taking your initial investment off the table, letting the rest ride. One of the keys is in trading is to cut losses short and fast if possible, and let winners ride long, and or get rid of underperformers and keep on your best performers. It kind of need to go against your instincts when you want to, and admit you were wrong and sell a loser or an underperformer, and not be so quick to take those profits if it's, not a time sensitive trade, and you want to just let those winners keep riding. So here you got a nice, double here on America, the U-Haul parent. And then the large caps, which also shows a summary of, the longer term history, closed out all these shorts. Here's a nice trade on Bluebird, biotech, Cheniere Energy, made a couple bucks on that. McDonald's and Iron Mountain didn't do so well. The other few, but we got stopped out for minor losses, and here we're covering for some decent gains. And this is like, July through October, so it's not such a long time frame to log some gains like this. So the long haul, this portfolio that began in 2001, we're averaging about 400 and some odd %. That's hypothetical, of course, with all the stock picks that we have since then. And we'll be putting out the next batch tomorrow. One of the patterns that I've been tracking is the 3 peaks in the domed house pattern. I've been tracking it since last October when we had the critical separating decline. This is a pattern created by the late George Lindsay. Sort of esoteric or funky way of describing, 3 pushes to a new high, then a breakout through there, and then sort of a head and shoulders top. And something I've been, I guess thanks to Doug Cass, I've been really tracking this time. He keeps asking me for updates, or told him yesterday he was asking me about it again. And this pattern is complete. Doesn't mean the market can't go lower, but the pattern calls for this 0.28 over here at the bottom on the right to return the market to the low point of the separating decline, which was points 10 and 14. There's a bunch of other points in here I don't track because it's not necessary. But the S&P didn't quite break the closing low here, but as I told Dougie, close enough for government work as far as I'm concerned, and I think we're done with this. And what I've got here is the next pattern setting up the W bottom formation, or the 1, 2, 3 swing bottom formation, where it sort of looks like a W, and the middle point 2 becomes the sort of crossover level. If you break this low down here on a close for the S&P even, this is the Dow we're looking at here, that sort of violates it. And if you can get above here and stay above there, that's your breakout indication, and that can also become your sort of stop level if you come back through there. But we've broken through, and this is from not too long ago today, so we're looking like we're breaking out of the W123 bottom in the seasonal, time period when that's supposed to happen, and we're getting back in. Not quite as bullish as I've been at other October buy periods with even the technical confirmation that we have there, because I think there's a great deal of weight on the market from economics and geopolitics and monetary policy and that sort of thing. So a couple other things we've been looking at recently, looking at down August and down September's. You can see that it's a positive for October and for the 4th quarter. Doesn't necessarily mean that the whole year, on average, is great, but it's a good sign for a decent rally into the year end. So, you get the typical 2 worst months down. You're going to get a potential, good probability of a gain in October and for the 4th quarter. So, sort of building on that, Q4 is still bullish after a down Q3, not quite as much, but it's still there. So we've got on this side over here just all the Q4s and the full year performance. So you can see, this is, after a down Q3, I'm sorry, I'm trying to point over here. You see a little bit lower average on the Q4 numbers, and of course a lower full year gain, and then after an up Q3 it's a little bit stronger. And then just to look at the performance of these Q3s that were all worse than 2015, not a bad outlook for the Q4 change, but concerning, pulling out a whole full year gain. Again, looking for somewhere in the, middle single digits, 5, 6, 7% from, the end of September through year end. Typical October action. Here we are on October 7th. This is trading day, so we're somewhere in this area. Could be a potential for a further test, maybe not all the way of the August lows, but some weakness still during the first part of the month, and then you see October being the best month to buy stocks, and you can see the all 4 of the major indices that we track doing well through month end. So you got that to look forward to this month. One of the things we do on a monthly basis in the newsletter is market at a glance. There's some more detailed copy that goes along with this, but psychologically, we were kind of skittish. This was at the end of September, looking towards October. We had, the investors' intelligence advisors being more bears than bulls after it being the exact opposite earlier in the year. We had some elevated put call numbers. We hit over 1 on the daily CBOE equity put call back in August, that August 24th, 25th week there. And on the weekly one that we like to track, which is one that's listed in Barron's, it's been there for years, never quite got to 1, but we had, the August number was 84 for the put call, and 81, I believe, was just towards the end of September when we had that second sell-off there. So we were in correction. I think that's over right now. We clearly, as you saw on some of the earlier charts, the S&P and Dow and NASDAQ, that correction was clear. We had no September increase. We were not expecting it. I'm not convinced that we're getting it this year. I said like months ago that we were looking maybe at March, or at least the first quarter of 2016, before we get the next, the first Fed increase in a while, the interest rate increase. People are now talking about it doesn't matter when. It's now the pace and the rate. My feeling is that when the Fed starts to raise rates, it's going to be a negative on the market. Maybe not immediately, but the work that we've shown is that rates go up, the market comes down. At least initially and for a little time. Seasonal, not only are we improving, we have improved. We've got technical confirmation. We are in the last month of the worst 6 months. We're in the best buying month. So we are in a good place seasonally. Pulse of the market. Here's some of the internals I had talked about earlier. You can see we look at something different here. It's another thing that you can read more about on our site or in the Almanac. It's down Fridays, down Mondays. It's something that we've been tracking as a warning indicator. Fridays have been horrible this year. This is not a sign of market comfort or market confidence when people sell off on Friday, don't want to go on the weekend exposed. And then it's even, often a worse indication when they come back in on Monday and they don't like what they saw or thought about or heard on the weekends, whether it was, at the dinner table with the family or on the news shows or whatever it was, and you get a sort of down Friday, down Monday being indicative of further declines, and we did decline further here. You can see one of the worst declines, a weekly decline for the S&P and the NASDAQ here at 6-7%. And then the market breadth here, we had this positive week, but really kind of an unimpressive market breadth with only 1,800 advancers to 1,400 decliners. The week before, we had a massive amount of decliners and not a whole lot of advancers, and then just continuing to not show a whole lot of upward progress in the advanced decline line. Back here on the new highs and new lows, we had only 18 new 52-week highs at the end of August, with 1,400 plus new lows. Not a real bullish indication there. You can see that we're still having some expanded new lows over here in the 200s and 400 a couple weeks ago. That's beginning to change a little bit, and we're looking for some improvement in these numbers, the new highs, advancers, and a reduction in lows and decliners. And here's the put call sentiment indicator that we track here, the weekly put call. You see the 84 and the 81 I referenced, and believe it or not, we were actually at 0 for the 90-day rate. That is not a typo, just towards the end of September there. Again, something that is unprecedented, and when it changes, I think will be a bit of a negative to the market, of course, depending upon whatever else is going on out there. So the October outlook for us, October phobia can be a self-fulfilling prophecy. We've sort of seen some of that a little bit early in the month. I think we got that phobia at the end of September. We've been seeing a lot of weakness at the end of the third quarter and that week after triple witching, which is something we spoke about a lot leading up to it. But October tends to be a bear killer. Don't believe we have an official bear market. I don't think we're going to get one, but we've seen October turn the tide in 12 of post-World War II bear markets. As I showed on that typical October chart, the first 8 days are kind of weak, but remember, it is the best month to buy stocks. We put in the majority of our sector trades in our stock basket that I explained a little bit, and we've got our best 6 months MACD seasonal buy signal, and it has been a little bit better after a down August and down September. And so that's what we're looking at going forward. We're kind of gearing up and starting to buy sectors and stocks. One of the things that we also do is with Probabilities Fund Management. I'm an investment committee member there, and they run a strategy based upon the Almanac and a bunch of other things like Congress being in session or out of session. They trade S&P ETFs, long and short. They use some leverage. There's a whole host of rules, but basically the philosophy is to be out of the market during high probability of downside risk and to be in the market during high probability of upside reward. And they're also running a sector rotation strategy based upon our sector seasonals. So there are, RIA Partners. It's tactical long short U.S. equity. They use Almanac cycles and seasonalities, different probabilities and strategies there. As you know, I am a member there. We do also own the mutual fund that it's out there, Probabilities Fund, PROTX. And as I said, we are working on the new sector rotation fund using our seasonal work. So, you can do all this yourself, either with all the other tools you use out there. Get yourself a Stock Traders Almanac. I know there's some people out there that have had a lot of success with it. You could join us on the website and get our service, the Almanac Investor at stocktradersalmanac.com. There's a code I have for the group today. It's 20% off. It's FEST15, and it comes with a free 2016 Stock Traders Almanac, and we send that to you for free. So instead of it being about $180, it's about $144 for a year. It's a pretty good deal. You're not going to get as much, I think, for that price anywhere else. Or you could let those at Probabilities, and which I'm involved with, run it for you with their rules-based systematic methodology, and where they've turned, you've got information, knowledge, and then wisdom, which is what we think we've put together with Probabilities there. So with that, I'm going to wrap it up here. I can take a bunch of questions, or you can find me at the website, stocktradersalmanac.com. Again, if you want to capitalize on that offer and get a look at the stock basket that we've got coming out on Thursday, tomorrow, use the code FEST15. I think it should be for the 1-year subscription. If somebody wants a 2-year or something like that, you can give me a call or send a note, and we'll figure it out and set up another code for you. So thanks, everybody. Thanks for taking the time out of your day, and I'm here for a little bit if you have any questions. Thanks.
All right, Jeff, we do have some questions in the question box. I don't know if you're able to read them or not.
I am trying to figure out how to do that. You want to just, let me see if I can pull it out to the side more. Let me see. There we go. Hi, Jerome. Okay.
You want to just, instead of typing it in, you just hit.
Yeah, I know. Was it you who revealed the end of the month effect? Thanks. We did a lot of work with that. I know Fosbeck, back in Institute for Econometric Research, did a bunch with that. We used to have something called the monthly 5-day bulge, where it was the it's changed. So the old one was the 5 days of the month. It was the last plus the first. Last 4 plus the first one, but now we're seeing more like the last few days and the first 2. So it's not just end of the month; it's turn of the month, and I think that's something that you can look at. And remember, that's not the same for every month. That's one of the things that we have in the Almanac, the little bar chart. We can see, beginning August is pretty crappy, whereas the beginnings of a lot of other months are not. And it depends upon whether you're at the end of Q3 or Q1 or Q4. So some of that stuff it's best to not take that in a vacuum and use it in conjunction with the other types of seasonal stuff, whether it's triple witching or the summer months or what's particular. And that's what we try to, we update that stuff every month in the newsletter. Jen, I don't know, is this recorded? I'm assuming it is. Am I bringing the almanacs to Vegas? God willing, Jerome. I have the order in to be shipped. They should be there, and I will have them for sale, and I'll be able to sign them and so forth. How does your forecast differ from Harry Dent's 10 years ago? In the book, the Super Boom, I mentioned some of that other stuff. The thing with Mr. Dent, and he's very successful, smart guy, his trend analysis work I always found very accurate, but the levels he's picked for the market have historically been way extreme on both ends. So when he and Haslett and Glassman, who put out Dow 30,000 in 1999 after the run up at the end of the 90s, it's completely different in my eyes because they put those forecasts out in 1999-2000, whereas I put mine out after the low in 2009. So, I look at things a little bit differently. While I do respect Mr. Dent's work, I think they're way too low and high on the levels of the market that they pick. Good question. Thank you. Whoops, I'm going the wrong way. Sorry. Can I go back to the bearish sector season summary? Whoops. It's in the book. You can get it on the website. Bearish sectors. How's that? If Mike's still there. Do I offer a trial? Yes, there is a 7-day free trial available. If you click on something to try to read an article, it'll prompt you to use a trial. NASDAQ decline was due mostly to biotech declines. Yeah, a good chunk of NASDAQ is biotech. Some of the other tech stuff was there, but that's okay. It's a nice buying opportunity for biotech for us. Twitter comment to Valiant Pharma price gouging. Yeah, and also Mrs. Clinton's comments exactly. I think that made it a bit more extreme. But, if it wasn't ripe for a fall, comments like that wouldn't necessarily have that kind of volatile effect on it. Mutual fund, PROTX, yes, that's the fund that runs our Almanac strategies along with some other rules and triggers they have on there. I'm happy to send anyone information on that who's interested. Whoops. Every market session, or is our website updated every market session? No, we don't have a daily update on there. There's so much stuff available out there. We update when we publish our articles again, but we're pretty much available if somebody wants to email a question or on Twitter. I'm at Almanac Trader on there. I pretty much reply to things every day, if not multiple times during the day. But market pricing, updated stuff on our website, no, that's not a value add for us. There's so much market data out there. When do I foresee a speculative phase of this bull market, such as I could run in 1999? I think we may have seen that. I think that was 2013, 2014. I think we're past that. I think we are more lined up for lack of gains and sideways action, and even a garden variety bear market of 20 to 30% sometime over the next years. I mean, they could have started already. The highs this year may end up, in hindsight, proving to be the highs of the cyclical bull market. But we could also poke above those a little bit by year end or Q1, even Q2, before this thing rolls over. It could drag out a little bit further and not happen until 2017 or 2018. But I suspect sometime between now and 2018, we will have had a 20 to 30% bear market, a broad market, measurement that marks the end of the secular bear market that began in 2000 and is the beginning of my aforementioned super boom. What year was the Dow? Oh, great, thank you. I forgot to mention that. 2025, and it's not will. That's the day. That's the year we're projecting it will get there by. And the other part of that forecast, which is happening now, is there's inflation, which we haven't really had. That's what that's built on. There's been about 30-some-odd% inflation since 9/11. That's likely to increase. It doesn't have to go up, like it was in the 70s to get this kind of move, to get a 5% move. Could be 50-70% by the time it's said and done in a few years. And then you have political functionality, which we don't have and haven't had. Kind of like, think Reagan, Tip O'Neill, or even Clinton, Gingrich, warts and all. They compromised and got some things done, at least got out of the way of the market. And potentially by 2018, the next midterm election, we might get some people down in D.C. who are willing to get some things done and not bicker and filibuster. Almost a perma bear, him and Praxair, Mr. Dent. Yeah, we try not to be perma bears or perma bulls. We try to, move with the signals, the market, what it's telling us, the indicators. Do you work with John Person? I'm planning to work with him again. I love working with John Person. We did the Commodity Traders Almanac together. We were working on putting it out for 2016, but time, and other things didn't allow us to get that done. But we're planning on doing the Commodity Almanac and working together for the 2017 book. Which school of econometric do you subscribe to? Oh. I'm not sure it would be any one particular school. I think, I like to be progressive and pragmatic in my thinking, and I think you need a combination of regulation and freedom. I'm not sure the school that I subscribe to actually exists. Maybe I should have somebody smarter than me start that so that I can subscribe to it. The January barometer. As January goes, question is, can you go over, I assume all you guys are seeing these questions, can you go over the January barometer? As January goes, so goes the year based on the S&P 500. Created by Yale Hirsch in 1972. There's 8 major errors for an average return of about an accuracy ratio of about, what is that? What's the number there? 89%. Throw in the flat year errors where it was plus or minus 5%, but the other direction, it's about 75% accurate. Basically, when you have all these events, new congresses convening, presidential states to the union, forecasts coming out of every wirehouse and analyst, and the new year beginning, you've got an opportunity to see where everyone's placing their bets and what the market looks like, and has been a great indicator. We try to use not just the January barometer these days, but since it's well known, it gets manipulated a little bit. Santa Claus rally is the last 5 days of the year and the first 2 days of the new year. There's a saying in the Almanac, if Santa Claus should fail to call, bears may come to Broad Wall. We saw that in 2000 and a couple of years prior to that when we had that 7-day period be negative. There's the first 5 days indicator. There is, we put the 3 of them together, and also, we will look at something that was brought to our attention by Jeff Saw at Raymond James, a gentleman named Lucian Hooper, called the December closing low. So when the Dow closes below its December closing low in the first quarter of the next year, that's another watch out indicator. 20% discount for 2-year. Hold on, we can make that possible. 10 for 2-year. You want to give me a code? MarketFest 10. Okay, hold on. I'll give you guys a code on that in a second. Let's see what other questions we got there. Thanks. What's BEM in this? Oh, that's beginning, end, and middle of the month of the sector seasonality. Labor 10. Oh, the Labor Day code. LABOR 10 is a 2-year 10% discount for 2 years. Did you get that? Commodity Almanac, last one was 2013. We do commodities in the newsletter service. You saw a couple of those trades in there, the livestock, the live cattle trade, the cow, and also copper. Remember I mentioned global brass and copper as one of the stock trades we picked up based upon the copper seasonality. We do stuff with oil and gas and, you know, the softs when they present themselves. There's a couple of currency seasonal trades that we'll put in there also in the pound. It seems to be the only one that we really have some real conviction with. Of course, there's the yen and the euro as well, and the Swiss franc not so much anymore, but it's incorporated in the newsletter service. You'll see it in, if you look at some of the articles, the sector seasonality trades. Page 26 of the slide. You got it, yes. I'm on it. I sound more optimistic than Rick Ellerman. You know, I'm told that people respond better to a happy, smiling presentation. Yeah, the difference in the lame question is there a difference in the presidential cycle when there's a lame duck president and not up for re-election? That's the whole point of the 7th year of the term. That's exactly what it is. And there's also, you know, we don't know yet if Joe Biden's running, but there's also a more, even less positive outlook when you don't have a sitting vice president running. So that's part of the whole negative action of this 4-year cycle. John is cool. He and I will end up speaking in Grateful Dead lyrics and Bill Murray Caddyshack stripe lines at any time. Hopefully I have a chance to chat with him and have a few laughs at the expo myself. Happy Canadian Thanksgiving, yes. Great. Fest 15 is not for the monthly. That's for the annual. Do we have a monthly one, Handy? Fest 15 for the monthly. Yeah, we'll put that in there for the monthly. All right, guys. I think I got through all the questions. Great stuff. Yes, there were some good, tough questions, but very interesting, very thought out. So with that, again, stocktradersalmanac.com if you want to reach us. Send us your comments, questions, reflections. Twitter is a good place to chime in and check on some things at Almanac Trader. Thanks, Mike, and happy Wednesday. Take it easy, everybody. Bye-bye. Thanks.